7 words. That's exactly what it took to plunge global financial markets into total turmoil this afternoon. 7 words uttered by someone who devoted his whole professional life to the planet's most influential central banks and who understood precisely which weak spot would inflict the greatest harm on the American economy. I've reported on financial meltdowns in the past. I've covered stock market plunges, currency breakdowns, and economic clashes among countries. Yet nothing I've witnessed compares to what occurred today between two nations that have stood as allies for more than 100 years. A disagreement that began over energy strategy has now grown into a development capable of completely redefining the worldwide financial structure. And the truly astonishing aspect is that virtually no one anticipated it, except maybe one individual who had been silently gearing up for this exact situation. Earlier today, after weeks of buildup, the globe observed an event without precedent in contemporary financial records. The U.S. administration unleashed its strongest economic tool against Canada, a NATO partner, a Five Eyes intelligence ally, and America's biggest trading companion. In mere hours, Canada fired back with a retaliation aimed squarely at the most exposed weakness in the U.S. financial framework. That reply proved so accurate, so crippling, and so skillfully designed that it instantly prompted a question now occupying the mind of every central bank leader across the globe this evening. If this can occur to Canada, the United States' nearest ally ever, what could possibly prevent it from happening to any other nation? The ramifications of that single question might transform the global monetary framework for decades ahead. I need to guide you step by step through precisely what took place today, since every particular carries huge weight. At 3:12 p.m. Eastern Standard Time, the White House issued a release declaring that the president had just signed an executive order placing instant financial curbs on Canadian banking entities conducting business inside the United States. The directive halts every correspondent banking connection linking the 6 biggest Canadian banks to their U.S. counterparts. Taking effect at midnight tonight, the White House presented this step as an essential action to safeguard American financial independence and to counter what the administration labeled as Canada's instrumental use of energy strategy against the United States. The release asserted that Canada's unwillingness to assure energy shipments had generated an intolerable threat to national security. It stated the United States would employ every instrument at its disposal to make certain Canada grasped the fallout from its choices, and it voiced optimism that the Canadian Prime Minister would rethink his stance once the economic consequences became clear. Under 2 hours afterward, at 5:08 p.m., Mark Carney conducted a news briefing in Ottawa. He stepped to the lectern, fixed his glasses, and stared straight into the lens. The statement he made afterward is destined to appear in economics textbooks for generations. Canada will now sell its U.S. Treasury holdings. Those 7 words constitute the gravest financial confrontation between two allied countries since World War II. Canada has just signaled its intent to unload more than $300 billion worth of United States Treasury bonds onto the public market. By taking this step, Canada has turned into a weapon the single asset the United States never imagined a trusted partner would target: America's debt itself. Bond markets responded in minutes. Foreign exchange trading floors shifted instantly into emergency status, and every central bank with substantial U.S. dollar holdings started making frantic calls to their peers globally. Allow me to explain exactly what this executive order accomplishes, because the specifics expose the complete magnitude of what Washington chose to release against Canada. Per the official text published on the White House website this afternoon, the Treasury Department receives instructions to terminate all correspondent banking ties between American financial entities and the 6 largest Canadian banks. Those banks together manage roughly $4.8 trillion in assets and maintain broad operations throughout the United States. A single one of these banks runs more than 1,000 branches along the American East Coast and manages more U.S. retail deposits than plenty of mid-tier American banks. The magnitude of this directive is hard to exaggerate. Beginning at midnight tonight, those Canadian banks lose the ability to clear US dollar payments via American banks. They lose the ability to finalize trades in US markets. They lose the ability to handle wire transfers via the US financial infrastructure. For US clients who hold accounts at these entities, it signifies their accounts become essentially locked. They cannot pull out cash, send payments, or move funds until the directive lifts or the bank detaches its US activities from its Canadian headquarters. We're discussing millions of American residents in places like New York, New Jersey, Florida, and Connecticut who will rise tomorrow morning incapable of reaching their own funds. Not due to any misconduct on their part, not due to bank failure, not due to any economic meltdown, but due to a policy clash between two administrations concerning energy strategy. The executive order further instructs the Securities and Exchange Commission to examine every Canadian bank listing on American stock exchanges and to weigh halting trading in Canadian bank securities should proof emerge that Canadian government policy creates system-wide danger to U.S. financial markets. This sort of phrasing typically applies to adversarial states, not treaty partners. Per accounts from individuals inside the Oval Office amid the talks preceding this directive, the president informed his team that this move would force Canada to surrender within 48 hours. The logic appeared simple. Canada's economy remains tightly woven into the US dollar framework. Canadian banks process about $400 billion in US dollar payments monthly. Severing that access would cripple Canadian business, Canadian exports, and Canadian financial markets. The White House figured the economic suffering would prove lopsided. Canada relies far more on the dollar framework than the dollar framework relies on Canada. With their banks isolated, the thinking went, the Canadian Prime Minister would quickly have to phone and plead for terms. It rested on pure financial dominance. The United States governs the dollar framework. The dollar framework forms the foundation of worldwide finance. Thus, any party reliant on that framework can be forced into submission by the threat of losing access. What the White House failed to factor in, however, was the opponent they selected. Mark Carney isn't some ordinary politician who drifted into economic matters via law or communications. He stands arguably as the most capable financial crisis handler presently heading any national government. He led central banks for a full decade amid some of the stormiest phases in recent financial history. He steered the Bank of Canada through the 2008 meltdown, when Canada became the sole G7 country whose banks avoided needing public rescue. He later guided the Bank of England during Brexit, handling currency turmoil and market fear live while preserving stability. He acted as special envoy, collaborating directly with sovereign wealth funds and central banks worldwide. When the White House opted to turn the financial framework into a weapon against Canada, they challenged a person who had spent his entire career within that very framework. He grasps its sensitive areas more thoroughly than anyone in Washington, and he recognizes precisely where the weak links lie. At 5:08 p.m., Carney approached the lectern in Ottawa and gave a reply destined for close study by financial historians for years. He started by outlining what the United States had carried out in clear, detached language. He pointed out that no U.S. president had previously applied financial penalties against a NATO partner, a Five Eyes member, and America's top trading partner. He stressed that the United States had turned the dollar framework into a weapon against Canada, the identical instrument America deploys against Iran, against North Korea, against nations it views as foes. And then he uttered words that placed the whole standoff in terms everyone could grasp. The president has chosen to handle Canada as an adversary. Carney stressed that Canada never invited this clash. Canada merely declined a suggestion that would have handed over Canadian control over natural resources. That refusal, he observed, represented Canada's entitlement as an independent country. The U.S. countermeasure was to strike Canada's banking network, lock accounts belonging to millions of Canadians and Americans, and try to bring down Canadian financial markets. Next, Carney detailed Canada's countermeasures. Here, the real elegance of his approach emerged. First, starting right away, the Bank of Canada triggered emergency swap arrangements with the European Central Bank, the Bank of Japan, the Bank of England, and the People's Bank of China. Those swap arrangements enable Canadian banks to keep processing cross-border payments in euros, yen, pounds, and yuan without depending on the US dollar framework. With one declaration, Carney rendered ineffective the chief tool. The United States had aimed at Canada. Canadian business would keep moving. Canadian banks would stay operational. The United States had excluded itself, and Canada would proceed independently. The briefing room went quiet while journalists absorbed the message. Then followed the second element of the countermeasures. Carney declared that the Canada Pension Plan Investment Board, overseeing $570 billion in assets, would launch an urgent assessment of its U.S. Treasury positions. Canada presently possesses roughly $319 billion in U.S. government debt. The pension board received directions to ready an orderly disposal of these positions across the coming 90 days. The funds would shift into European government bonds, Japanese government bonds, and gold holdings. The room exploded. Journalists yelled questions. Carney raised his hand and went on with a thorough breakdown of the implications. Should Canada place $319 billion in Treasury securities on the open market, it would drive up U.S. borrowing expenses, it would lift U.S. interest rates, it would undermine the U.S. dollar, and it would broadcast to every nation holding U.S. debt that the United States stands ready to turn its financial framework into a weapon against its nearest partners. Every central bank worldwide, Carney stated, will pose the identical question tonight. If America took this step against Canada, what would prevent them from taking it against us? Carney then disclosed something that sent the Treasury Department's lines buzzing at once. He revealed he had conferred that afternoon with the heads of the central banks of Japan, Europe, the United Kingdom, and China. All four voiced deep worry regarding the United States' choice to weaponize banking connections against a treaty partner. All four consented to initiate emergency funding facilities with Canada, and all four signaled that their institutions would reassess their own U.S. dollar reserve positions in view of today's developments. Canada, Carney stressed, stands far from isolated. The worldwide financial community is observing closely and feels disturbed. This wasn't a frantic reply from someone blindsided. This represented a synchronized forward position countermeasure from a leader who foresaw this possibility and readied for it weeks earlier. The market response to Carney's declaration arrived swiftly and sharply. In under 20 minutes, the U.S. dollar index fell 3.1%, recording its biggest one-day drop in more than 10 years. The yield on the 10-year U.S. Treasury note jumped from 4.38% to 4.91%, while traders factored in the chance that $319 billion in Canadian-owned treasuries might pour onto the market. The 30-year Treasury yield surpassed 5.2%. For everyday Americans, these figures mean tangible expenses impacting their routine existence. Mortgage rates linked to longer-term Treasury yields are expected to climb by a full percentage point within days should the disposals commence. That equates to the typical American mortgage payment rising by about $340 monthly. For households already strained by inflation and elevated housing expenses, this difference could determine whether they hold on to their house or forfeit it. This goes beyond theoretical finance. This represents the immediate outcome of turning the financial framework into a weapon against a partner who understood precisely how to retaliate. U.S. bank shares plummeted following the announcement. Leading American financial companies watched their stock values decline between 8 and 11% within minutes. Markets now price in the danger that a U.S.-Canada financial conflict might spark wider disruption across the global dollar framework. At the same time, gold climbed $127 per ounce, reaching a record peak as investors rushed towards secure assets. The signal from markets leaves no room for doubt. Carney's warning carries weight, and the fallout from acting on it would prove catastrophic for the United States. What renders Carney's countermeasures so strategically powerful isn't merely the Treasury warning, but the swap network he set in motion. Those arrangements permit Canadian banks to keep functioning in worldwide markets without relying on the US dollar. They can finalize trades in euros, yen, pounds, and yuan. They can process payments, handle transactions, and sustain liquidity. The US banking restriction aimed to disable Canada's financial network. The swap arrangements largely cancel that threat, per people familiar with the Bank of Canada's advance planning. These arrangements weren't arranged today. They had been readied over weeks. Carney recognized the risk of financial escalation and positioned Canada's safeguards well before the executive order received a signature. That's the gap between a leader who comprehends financial frameworks at their core and one who regards financial frameworks merely as instruments of pressure. Yet another layer of this crisis has produced an urgent humanitarian issue inside American territory. The executive order impacts a bank running over 200 branches in 15 U.S. states and safeguarding roughly $380 billion in deposits belonging to American clients. From midnight tonight, those clients lose access to their funds. They cannot cover mortgage payments, settle bills, take out cash, or move money. The FDIC released an urgent notice stating it is tracking developments but has yet to decide if these U.S. activities qualify for federal deposit insurance coverage under these exceptional conditions. Legal specialists describe this as entirely unmapped ground. No president has previously halted the activities of a sound foreign bank lawfully present in the United States. Court challenges are anticipated to arrive by tomorrow morning. Attorneys general in states along the eastern seaboard have already declared they are examining the executive order's lawfulness. Elected leaders in impacted states have released angry statements highlighting that millions of their residents who committed no wrongdoing will lose access to their funds due to a policy disagreement with Canada. The political repercussions from this choice have barely started to surface, but they are approaching fast. The gravest aspect of Carney's declaration concerned not Canada's Treasury disposals themselves. It concerned what those disposals communicate to every other nation globally. The US dollar's role as the world's reserve currency rests on one vital premise: that the United States will refrain from weaponizing dollar access against nations following international standards. The US has applied financial penalties previously, but always toward countries breaching global rules. Iran pursued nuclear capabilities, North Korea endangered regional peace, Russia invaded Ukraine. Canada breached no global rules. Canada merely declined to enter an energy pact. And as retaliation, the United States severed Canada's link to the dollar framework. Every central bank leader worldwide tonight is posing precisely the question Carney foresaw. If America took this action against Canada, what prevents them from taking it against us? Per contacts at the Bank for International Settlements, a minimum of 7 central banks have already sought urgent discussions regarding speeding up their shift away from U.S. dollar reserves. Should even a portion of worldwide dollar reserves move toward euros, yen, or gold, the effect on U.S. borrowing expenses and U.S. economic influence would last for generations. The United States finances $2 trillion annually. That financing hinges on overseas appetite for U.S. Treasury securities. Should that appetite weaken, interest rates climb, the deficit grows costlier to manage, and America's capacity to exert economic influence shrinks for good. Carney grasps this mechanism thoroughly. He devoted his career to overseeing reserve currencies. He recognizes that the dollar's strength stems from confidence, and that this executive order has just destroyed that confidence with America's nearest partner before the eyes of the entire planet. Allow me to outline 3 plausible paths for how this crisis might develop moving forward, because the spectrum of possibilities stretches extremely broad. In the first path, swift de-escalation, the legal and political backlash from locked bank accounts compels the White House to withdraw the executive order inside 48 hours. Millions of American voters in key states find themselves unable to reach their accounts. Pressure from Congress grows irresistible. The order gets withdrawn, accompanied by assertions that it fulfilled its goal. Canada pauses the Treasury disposals but leaves its swap arrangements intact. The underlying harm has already occurred. Canada now possesses lasting financial architecture functioning separately from the US dollar framework. Other nations quietly hasten their own diversification. The dollar stays preeminent, yet its exclusive position starts to erode. In the second path, the president stands firm, and Canada commences selling U.S. Treasury securities in batches of 30 billion weekly. The 10-year yield reaches 5.5% inside a month. Mortgage rates surpass 8.5%. The U.S. housing sector stalls. Stock markets slide into bear territory as elevated borrowing expenses hammer company valuations. The Federal Reserve must step in, purchasing treasuries to steady yields, essentially creating money to take in the bonds Canada offloads. Inflation surges, the U.S. dollar depreciates more, and the political struggle surrounding the president's power to enact such penalties turns into the year's central conflict. In the third path, Canada's swap network alongside Europe, Japan, the United Kingdom, and China evolves into a lasting alternative settlement system. Canadian energy shipments get settled in euros and yuan instead of dollars. Additional resource exporting countries watch Canada's outcome and start pursuing their own non-dollar deals. Within 18 months, the portion of worldwide trade cleared in U.S. dollars falls markedly. The dollar continues as the biggest reserve currency, but loses supremacy. U.S. borrowing expenses rise permanently. The period of American financial dominance doesn't conclude with a collapse. It concludes through a gradual, unstoppable shift toward a multipolar financial order, sparked by a U.S. president who chose to penalize Canada. The dollar's strength never rested solely on military might or economic scale. It rested on confidence, the confidence that the United States would avoid capriciously blocking allied countries from the financial framework. That confidence now lies shattered. And a former central banker who rose to prime minister has just demonstrated to the world precisely what occurs when you treat your closest partner as an adversary.